Okay, we're on to section 6 here, which is all about building value in a business. Most of us probably want to sell our business on at some point in the future. So one of the things that we're always fairly bad at in small businesses is keeping track of how well we're doing. As you will have gathered by now, I'm quite a fan of the balanced scorecard approach, and I thought it would be interesting to look at some of the issues that are involved in trying to value a business and various ways of approaching it, and at the same time giving us some indicators which will tell us that the business is basically on track and going in the direction and is sort of healthy in a holistic sense. So this has been based on some conventional wisdom from the marketing area, plus some research which was carried out by Cranfield for the Small Business Service in about 2004, which looks at how the average of small British companies actually do perform. So I would say that in a way what we're trying to do is to sort of build brand equity, because that's what people buy. In other words, it's a sort of fancy way of saying goodwill, really, but it is what we will be selling at the end of the day. So how do we measure it? Well, in a publicly quoted company, it's quite easy, because it's the market value as delivered by the share price less the tangible asset value of the business in terms of the kind of valuations of the plant, goodwill, and all of that kind of stuff. However, in a unquoted business, there's no sort of yardstick of how much anybody would be prepared to pay for the company. So there are various ways of approaching it from a brand equity perspective that have been developed by various sort of marketing organisations. One way is the value of passive sales, which is the approach which I actually rather like myself, which is from a way of understanding what's going on, which comes from a company called Interbrand. Fundamentally, it's the premium over what you get from mechanical marketing. You'll recall from the session we did on sales and marketing that what we're trying to do is to build a sausage machine that you do. If you talk to enough people, you go through the sort of process, you get a certain number of sales, or if you're in the online world, you basically advertise a certain amount with Google, you get a certain number of clicks, a certain percentage of those convert into sales. That's what I would call the mechanical approach. The amount of energy you put in basically delivers a certain quantum of sales. However, if your reputation is good, you'll get a premium in the of maybe 20, 30, 40% more sales than you would predict from just the process of mechanically going through the sales cycle. And that is effectively the value of your brand equity. It's the premium that you get from having a good reputation. And ultimately, as I've argued consistently here, that's down to how well you deliver your promise to the customer, whatever that might be. There's a couple of other things here. Moran regards that your brand equity is effective market share times the price premium you get times the loyalty, the amount of repeat business you get. But that's quite hard to quantify from a small business perspective, as is sort of Young and Rubicam's approach, which is about differentiation, relevance, esteem, and knowledge of the brand. I think that I've mentioned these two to give you some ideas of what could be evolved, but in practical terms, it's probably going to boil down to the rule of thumb, which is, in general, 3 times the net earnings of the company. We acquired our biological control business in that way. The vendor said that, well, this is how much we earn from it, so I want 3 times that. And we sort of huffed and puffed a bit, but in the end it's a fair price, and that's what we went for, and that was good for them and it was good for us. We've succeeded in building that business over 4 or 5 years, so that it's probably doubled the amount of money it makes for us. But I think you have to understand, that the flaw in the share price less tangible value approach is that actually most value is intangible. Professor Strassner, who did a study of this, reckons it's 80% of a modern business's value is intangible. And if we follow the ideas of the balanced scorecard, where is that intangible value? It lies in what's in people's heads and how innovative they are, informal intellectual property rights, trademarks, patents, copyrights, in the customer base, and the ability of ourselves to farm our customers, in the processes of the company, and in its contracts and financial strengths. And as I keep banging on about, brand is really all about reliable delivery processes. So you need to be measuring how robust your processes are, and that includes how happy your staff are and how well they relate to the customers in the way that they operate the processes. Now, you need measures that you can get at easily. I mean, the problem with the sort of Young and Rubicam and Moran approach is it's very difficult to get at those things, although conceptually it might be right. What can you get at easily? Things like debtor days and creditor days, cash flow forecasts. How many weeks cushion do you have in cash at the bank? The best companies probably have about 8 or 9 months worth. What does your customer data tell you? You really ought to be mining your customer data as to what they like to buy and what other things you might sell them. You need to organise the accounts so you can see how the different bits of the business are working. One of the things that always used to drive me nuts when we had a computer business is that there must be, hundreds of thousands of copies of Sage out there, of which 95% of them are just using the chart of accounts that comes in with the default that comes with the system. You're really missing a trick if you do that. You need to be able to know which bits of the business are making money and which bits aren't, and so you can bear down on the costs or do more of what's working. And how can you test how well your staff are doing, how happy they are? Well, in a sort of 10-man company, if you don't know, then you're probably not running it very well. But when you get up to about 25 or 30, it's useful to have some kind of surrogate measure. Now, what's useful is that actually all the statistics show that staff motivation correlates with how many sick days they take and how many accidents they have. Accidents you have to track by law in your accident book, so it's easy to keep track of that, although I've actually chosen to use absences as my surrogate. But either of them would do. And also you probably need to do some key balance sheet ratios for the financials. So, when I had the luxury to think about these things when I was working for the Business Link, I amused myself by taking the data from the Cranfield benchmarking study and picking out a couple of indicators in each of the sort of 5 categories of the balanced scorecard, which would be useful. So I've reproduced them here together with the actual values that were published. So one thing is the percentage of business that comes from new products. The average for all service companies in the UK is about 8%. The best companies do 22%, and the bottom quartile do 3%. So you might ask yourself how well you're doing there. Another one I think for innovation is basically how much money do you spend on research and development as a percentage of your turnover. The average in the UK is 1%. The best companies do about 4%. Now, coming back to the absenteeism, best companies, you only get 1 unauthorised absence per employee per year. The average is about 2. When you think of what the BAA were trying to bribe their staff on the check-in desks to come up to, you can see that really that's a pretty unhappy company. The other indicator that I've used here is training per employee, because that's easy to get at. Although personally I might think you might want to track the number of graduates you have in the company, because that drives all kinds of innovative things. If you want to look at the customers, easy things to get out is complaints per customer. And the other thing is the percentage of new customers that you get per year. Now, the top companies actually create a lot of new customers per year, whereas the average companies are 20%. Now, since we know that the average lifetime of a customer is only about 5 years anyway, because people die, companies close, your contact moves on, then actually the average company in the UK is only just replacing the churn, the decay in the number of customers it has. So you really want to be focusing on doing a bit better than that. Now you come to systems. What is it that tells you how well a company is run? Debtor days is quite an easy one to get at, although you might consider using creditor days because creditors, you always know who owes you money, but what really knocks your cash flow for six is somebody you've forgotten about who suddenly comes out the woodwork demanding money for menaces. But you can see here that the average UK company has its debtors owing it money for 2 months. Now that's a fantastic overhead on the company. That means that you have to fund either with the bank or with your own resources 2 months worth of trading. So if you're turning over 1.2 million a year, that's £200,000 you have to find just to stay afloat. So that's something that's really worth working out in tightening up your credit control. The other one here is I put in is value add per employee, because that tells you effectively how well you're deploying the staff that you've got. And then we come to financials. I've chosen to use pre-tax profit over turnover, and the average is only about 5%. But a quarter of UK companies are making 1% or less. That's fairly shocking. So you should aim to do, to be in the top half at least of the field. Return on capital employed is ROCE, and that's actually quite a good measure of how effectively and efficiently you're using the resources you have at your disposal. And the acid test ratio is basically about debtors to credit ratio, only it's a bit more crunchy because it takes stocks out of the equation. So fundamentally that measures how solvent you are. So the average British company is just about solvent. So those are the things that you might consider measuring to know whether you're going in the right direction or not. I mean, if you want to be successful, you need a strategic vision of markets, competitors, and the way forward. You need to be able to communicate it. You need professional management expertise in marketing, IT, new product development, and a balanced scorecard approach. I mean, you might provide some of that professional management expertise yourself, but you do need to have some of it on tap. I think the structured HR and training is very important because it makes a big difference. You can tell the difference between the companies that have it and the companies that don't. And although, again, I wouldn't go overboard on it, because our mantra should always be about getting just enough structure in place. Nevertheless, a little bit of time and effort and money spent on getting the basics in place will stand you in good stead. And then I think you need to sort of network strategically to find suppliers and collaborators to go after perhaps a larger company. I think the easiest way of doing this is to sort of adopt the sort of processes or ideas of the learning organisation. This is based on a book by Peter Senge called The Fifth Discipline. And he identified 5 building blocks that were successful, that were required for a company to become a learning organisation, to continually take what's going on in the marketplace, improve its own processes, and generally develop its value in an integrated way. And those things are, he calls it personal mastery. It basically means insisting on doing things right the first time, getting it right. Having a mental model of what you're trying to do and sharing it with the team, making sure that the team learns as a group in conjunction with that shared vision that comes out of this sort of mental model, and finally trying to get systems thinking throughout the organisation so that we do it right first time, so that we build a joined up and holistic organisation. So just to reiterate, you need to be looking at how you build the value in the company, and remember, it lives in people's heads, in formal intellectual property rights, in customer related information and relationships, and in the business processes. And I would argue that you should be involved embracing IT, electric communication, trading and purchasing, mobile and flexible working, collaboration, and above all focus on security and disaster recovery, because we know that of companies that lose their data through whatever reason, only about 7% remain in business. So you definitely don't want to have to go through that. So that's fundamentally what I have to say about building value. If you need any help with thinking about these, happy to have a chat with you, or you can basically sort of sign up for some of our offers that we have here. Thanks very much.